Everyone, we're starting a new series on options. So we're going to go over all the basics. And even if you're already familiar with options, go ahead and watch these videos because I'm sure you're going to learn something. And then once we have the basics understood, once we have a few videos out of the way, then we'll even show some live options trades and discuss how people can make money with options. So let's start with this video, and we're going to be going over what is an option. This is going to be in two parts: the history of options and what is a call option. So we're going to really cover all the initial basics, and by the end of the video you'll also understand this chart on the right. So if it looks confusing now, don't worry, you'll understand it by the end of the video. Okay, so options have ancient origins starting from Greece, and the picture on the right is Thales of Miletus from the 6th century BC. So he was a philosopher, but he didn't have that much money. He expected that the next year's olive harvest was going to be abundant. There's going to be a lot of supply of olives. So he thought, how can I make money from this? He placed a deposit to be able to use the olive presses next year. So he put down money, and if he wanted to use those olive presses, then he would have the option to do so. And if he didn't, then he would just lose his deposit. So he had the right, but he was not obligated to do so. So he was paying for the right, and but he was not forced into it. So what was good about this? His risk was limited to his deposit. He was basically making a bet, and whatever his maximum loss would be his initial deposit. And his upside was unlimited, right? If the olive supply was very, very abundant, and he could have the rights to those olive presses, and he could just keep those olive presses running and make money that way. So Thales executed the first call option. And this is a nice segue into our next slide, which is going over the modern call option. So keep this story in mind as we're going over the call option. So it's purchasing the right, but not the obligation, to buy stock at a certain price and date in the future. So don't get too worried about if you don't immediately understand that sentence, because we're going to cover it all. Options are not easy, but once you get it, it's like riding a bike, and you're going to be fine. So let's use an example. I think GameStop is going to go up. And today, let's just use February 1st as an example. Let's say GameStop's at $22. So what I could do, I could find a $20 call option expiring 6 months from now in August. $20, that is the strike price. And this is our first vocabulary word, the strike price. That is the price per share that you want to pay in the future. So if it's expiring on August 1st, then by August 1st, I want to have the right to buy the GameStop stock at $20. Now, GameStop is already at $22. That means there is inherently value in this option. So if I could buy at $20 and immediately sell it at $22, the other party has to be compensated in some way. So look at the same example. I have to pay for the right to buy at $20 a share in the future. And new vocabulary word, this is known as premium. And premium is basically just the price that you're paying for that option. So there's $2 of premium based on the difference in price alone. If we can buy it for $20 and GameStop's already at $22, there's $2 of premium just in the difference alone. There's actually going to be a little bit of additional premium, and we'll explain why. So you must pay me at least $2 to have the right to buy a share in the future at $20, and we're going to see why it's at least $2. So talking more about premium, once again, premium is just the price of the option. So they're synonymous. So price is equal to premium. The share price, $22. Our strike price is at $20. If you look at the option price, in this example, it's actually $2.50. So the premium, the option price, it's not just $2. It's actually more than that. It's $2.50. So why? Well, we'll answer that. Time is on your side is one reason, right? That has to be worth something, that you have several months to be able to make that decision. And that decision is yours. You get to decide if you exercise the option or not. And we'll learn more about exercising later. Exercising is when you actually want to act on the option and you actually want to buy the shares. The third reason markets have volatility, which means the price moves around. So it's unlikely to just stay around that $20, $21, $22 range over the next 6 months. There's a good chance it'll be down around $15 or up around $30. There's volatility in the prices of stocks. So the more those stocks move around, the higher the volatility and the more premium there is in the option. So our intrinsic value, a new vocabulary word, intrinsic value is $2. This is just the difference between the strike price and the share price. And we have extrinsic value of 50 cents. So the two of these combined make up the whole premium, the whole option price. So if the intrinsic value is $2, the option price is $2.50, that means the remaining amount is extrinsic value of 50 cents. And extrinsic value is these Y's down here. Extrinsic value is the time that's left. So more time, more extrinsic value. And the volatility. More volatility, the greater the extrinsic value will be, then the greater the option price will be. Let's look at some examples. Okay, outcome one. Let's say you're the call option buyer. You buy a call option at a strike of $20 for $2.50. Okay, so on July 1st, GameStop has gone up. It's gone to $25. This is good. We're the call buyer. We want that stock to go up. So they exercise the call and buy 100 shares at $20 each. So remember, exercising is just going through this process of actually ending the contract and buying the shares. Now, it's 100 shares because this is the standard amount of shares in an option contract. So this is anytime you're dealing with options, one option would be for 100 shares. So here's our math at the bottom. We paid $2.50 up front. That was the price of the option. And then we made $5. So we exercised the call and we bought the shares at $20 each. But remember, the market price is $25. So we had the right to buy them at $20, which we did. Then we turned around and we sold them at $25. So that's a difference of $5. So we made $5 on that transaction. We paid $2.50 up front. Then later on we made $5. So we made $2.50 per share on the option. And it's with 100 shares, so that would have been $250. Now, this is just our side of this contract. There's the other side as well, the call option seller. So they're just doing the opposite. They're taking the opposite side of our trade. They're selling a call at a strike of $20, and they receive a credit of $2.50. So a new vocabulary word there, the credit. So we paid $2.50 up front as the buyer. Then the call option seller, they received that $2.50. They received that credit. So once July comes around and GameStop's at $25, the buyer had exercised the call and bought 100 shares. So as the seller, we have to sell them those 100 shares. This means we've been called. So the call option seller has been called here. They had 100 shares, and now because of this option contract, they're being forced to sell those 100 shares at the strike price. So, there's different ways to look at this. One is that the call option seller already had 100 shares, and then they entered this contract. Another way to look at it is that they, going into it, they did not have any shares. They can still take the other side of this bet without having any shares. But what happens when the option is exercised and they have to come up with these 100 shares to sell? Well, they would go into the market and buy the shares at $25 each, right? We have this agreement. We have to sell shares to this person, but I don't have any shares. So they have to go into the market and buy them at $25 each. And then they have to immediately turn around and sell them at $20 to the call option buyer. So they received $2.50 up front as the credit. And then on this transaction, they lost $5. Remember, they had to come up with these shares to sell to this person. So they had to go and buy them at $25, and they turned around and sold them at $20. So that's a loss of $5 per share. And the total loss was $2.50 per share. They made $2.50. They lost $5. That comes out to minus $2.50. And an important note, this profit for the buyer is the same loss as the seller because they took the different sides of the same trade. Okay, so we're going to look at a second example, and as we do more examples, it'll help you cement these ideas in your head. I would not expect anyone to fully grasp all this at first. So, it's just something you just take time on and work through it. Okay, so example 2. The initial situation is going to be the same. So the buyer, they buy a call option at a strike of $20 for $2.50. They pay $2.50 to have the right to buy it at $20. Now, on August 1st, this is when the option contract is expiring. The GameStop, it went down. It's at $19 now. It was at $22, and now it went down to $19. So they decide to not exercise the call because it would be a worse loss than if they just let the option expire worthless. And I'm going to explain some of this on the next slide as well, and we're going to kind of go over the different scenarios. In this situation, they do not exercise the call. Okay, so the time ran out. They had the right to exercise the call and to buy the shares, and they decided not to take it because the loss would have been greater if they did that than if they just let it expire worthless. So remember, when you're buying an option, your maximum loss is what you pay up front, and they pay $2.50 per share up front. And turns out this loss is less than the loss if they would have taken, if they would have exercised. And I'm going to explain that on the next slide. But let's look at the math for the seller in this situation. Remember, they sold the call at a strike of $20, and they received a credit of $2.50 up front. Same situation, the options expire worthless. Okay. Their profit is the $2.50 per share of credit that they received up front. This contract, the deal was that they would be obligated to sell shares to the buyer if the buyer decided to do that. But the buyer decided not to do that. So the math here is very simple. They just keep that initial profit of the credit that they received up front. And there's no other transactions that are made. So let's take a moment to visualize what we've been talking about. And we're also going to learn about the break-even point. So looking at our same example, strike price of $20, and we're paying $2.50 for the option. Notice down here where our strike price is, the max loss flattens out at $20. So we can't lose any more beyond or under $20. So if GameStop goes below $20, then that's our max loss. So once it goes below that point, it doesn't matter how much GameStop goes down, because remember, it's like our deposit. We paid up front to have the right to buy or to not buy. So if it goes below the price where we would lose more money, then we just don't exercise that option. And the chart also, from left to right, price is increasing. So GameStop would be at $20 here in this example. Then as price increases, notice our loss goes down and down. So we would lose less and less money as the option goes up. And at some point we reach our break-even point. So this is where our profit is basically zero. And above that, then we would have profit. And that break-even point is the strike price plus the option premium. That's what we paid for it, which is $2.50. So the break-even comes out to $22.50. Our maximum loss is limited down here at $2.50 below the strike price, but the maximum profit is unlimited. If GameStop goes up to 100, then that would all be profit for us. So that's what a call buyer is doing. They are paying extra to have a maximum loss and an unlimited gain. As you see here on the left, this is our maximum loss, $2.50. So as the price goes down, we would lose more and more money until we get to our option price of $2.50, and then that's where it flattens out. So we would not lose any more than $2.50. And the share price must rise to $22.50 to be profitable. So as each week, each month goes by, we have to, no matter what, we have to get above this $22.50 to be in the profit. So if you think about the example from the prior slide where GameStop actually went below 20 and went down to $19. Look, $19 would be, it's below that strike price, so we've already hit the maximum loss. So now you bought the call option, so you always have the right to exercise it if you want. You always have the right to actually buy those 100 shares, but you'd be buying them at $20 instead of 19. So your two choices, you would either lose $2.50 by just letting the option expire worthless, so which means you just don't do anything. Your other option is you exercise it and you buy the shares at $20, but the option price is already below that at 19. So if you bought the shares at $20 each and then turn around and sold them at 19, which is the market price, then you would lose $1 per share there. So you would lose your $2.50 up front, and additionally, you would lose your $1 because you bought them at 20 and sold them at 19. So you would actually lose $3.50 per share on the whole transaction, which is why once you're at your maximum loss, then you should just let the option expire worthless instead of trying to exercise it. So that might have been confusing, but that's an important point to get down. And so, feel free to watch these last couple slides over again to make sure you can get this idea. Let's talk about more about option prices. So the option buyers, they have a known max loss. They're going into the agreement, then they know what their maximum loss is going to be. They have unlimited profit potential. This is one of the reasons they're paying for the option in the first place. They want to have a known max loss, and they want to have an unlimited profit potential. So they're willing to pay the option premium, that option price up front for it. An important point to remember is that options contain 100 shares. So in the example we've been using, the option price was $2.50. Well, that is per share. And since options have 100 shares, then you must pay $250. So anytime you're dealing with options, you're going to see a price like this where it's $2.50. And in your head, you need to understand that it's going to be 100 times that because you're dealing with 100 shares, which would come out to $250. So let's look at a real example. And new vocabulary word is the option chain. The chain is where you actually see all the different strike prices and the prices for those strikes. So you'll see, let's say this $22 strike price. Here, the price for that is $5.15. So if I want to buy an option at the $22 strike price, I have to pay $5.15 per share, which would come out to $515. So, pull up any trading platform that you're using, and the chain is going to look something like this, where you have your strike price and then the prices for that strike price. And just remember that the quoted price here, multiply that by 100, and that's the total price you would pay for that contract. So let's do a pop quiz now that we've finished this first video. So what does the strike price represent? Is it A, the price you paid to buy the option, otherwise known as the premium? B, is it the price the stock reaches at the end of the day? C, is it the set price at which the option holder can buy or sell the underlying stock? Or D, is it the fee paid to the broker for executing the trade? So let me know in the comments what you think and what you learned from this video. This is not an easy concept to understand initially, once you think about it and practice it and take time, you'll get it. But at first it's hard. So if you have any questions, leave them in the comments and I can get back to you and help you work through whatever problems you're having in understanding it. And check out the second video. And we're going to have several videos in this series kind of fully covering at least the basics of options. And I think this is going to be a really helpful series. So keep an eye out for the future videos.